If you invested $1,000 in the stock market today, you'd hope to turn it into a decent retirement. Warren Buffett took $1,000 as a kid during the Great Depression and turned it into over $130 billion. His secret wasn't a magic formula. It was an insane level of patience that almost no one else on earth possesses. Meet the world's most successful investor. And this is the complete story of how he built a multi-billion-dollar empire from absolute scratch. In a modest house in Omaha, Nebraska, in the summer of 1930, while the country outside was sliding into the worst economic collapse in its history, a boy was born who would spend the rest of his life thinking about money the way other people think about air, as something so fundamental to existence that most people forget to notice it at all. His name was Warren Edward Buffett. His father, Howard Buffett, ran a small stock brokerage in Omaha and later served in Congress as a fiercely principled, almost ascetically honest Republican who refused free favors and returned unused expense funds to the Treasury. His mother, Layla, was volatile and prone to sharp verbal outbursts that left lasting marks on her children, a household tension that Warren would later learn to escape through numbers, which never yelled and never changed their minds depending on mood. From an early age, he retreated into figures. He memorized the populations of cities. He timed things with a stopwatch. He kept ledgers. While other children played baseball simply to play it, Warren wanted to know the batting averages behind every swing because a number, once understood, could be trusted in a way that people could not always be. He was around 6 years old when he made his first trade, buying 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and reselling the individual bottles for a nickel each, pocketing a 5-cent profit on every 6-pack. It was an almost laughably small transaction, and yet it contained in miniature the entire architecture of his later life. Buy something for less than it is worth, sell it for what people are willing to pay, and repeat the process with discipline. At 9, he was already selling chewing gum and magazines door to door in his neighborhood. He was not a gifted athlete and not particularly interested in becoming one. His currency was arithmetic, and he understood before most adults did that compounding a small amount of money patiently was more powerful than any single windfall. When his father won a seat in Congress in 1942, the family relocated to Washington, D.C., a move that Warren, then in 4th grade, deeply resented. Uprooted from Omaha, he grew homesick and miserable, and the anxiety showed itself physically, eventually convincing his grandfather to let him return to Nebraska to live for a while before the family reunited in the capital under calmer terms. It was in Washington, however, that his entrepreneurial instincts sharpened into something closer to a business. He took on a paper route delivering the Washington Post, and being Warren, he did not deliver one route. He built several, stacking overlapping routes together, with the calculated efficiency of a much older man plotting a network. And by the time he was in his teens, he was earning more than many adults in full-time jobs. He filed his first tax return at the age of 13, claiming a $2 deduction for the bicycle he used on his paper routes, a small but telling detail. He understood, even as a child, the mechanics of taxation as intimately as he understood the mechanics of selling. At 14, he used his savings to buy 40 acres of farmland in Nebraska, which he then rented out to a tenant farmer for a share of the crop, turning himself into a landlord before most of his classmates had held a summer job. Around the same age, with a friend, he purchased used pinball machines for a small sum, placed them in barbershops, and split the earnings with the shop owners, eventually expanding to several machines under a company he registered under a fictitious name, so the barbers would not know a teenager was behind it. He sold the pinball operation for a profit within a year, an early demonstration of a habit that would recur throughout his life. Enter a business, understand its mechanics completely, extract value from it, and exit cleanly when the opportunity had run its course. He enrolled at the University of Pennsylvania's Wharton School at 16, but he found the environment unsatisfying. The professors, in his eyes, were teaching theory disconnected from the practical business instincts he had already been living out since childhood. And he transferred back to the University of Nebraska-Lincoln to finish his undergraduate degree more quickly, graduating at 19. He then applied to Harvard Business School and was rejected after a brief interview in which the interviewer judged him at 19 to look too young and underprepared for the program. a rejection that Buffett would later describe as one of the best things that ever happened to him because it redirected him toward Columbia Business School, where a professor named Benjamin Graham was teaching a course on security analysis. Graham was, at that point, already the author of a book called Security Analysis, and would soon publish The Intelligent Investor, works that laid out a systematic approach to buying stocks based on their calculable underlying value rather than on speculation, momentum, or story. Buffett had, by his own account, encountered Graham's ideas before enrolling and had been captivated. Sitting in Graham's classroom felt, to him, like finally hearing a language spoken fluently that he had only been guessing at before. He absorbed the concept of margin of safety, the idea that an investor should only buy an asset when its price is meaningfully below a conservative estimate of its true worth, so that even if the estimate proves wrong, the investor is protected from serious loss. He also absorbed the metaphor of Mr. Market, Graham's personification of the stock market as a manic, depressive business partner who shows up every day offering to buy or sell at wildly different prices depending on his mood, and whom the rational investor should ignore, except when his mood swings create an opportunity too good to pass up. Buffett was the only student to whom Graham ever gave a grade of A+ in his years of teaching, and he graduated from Columbia in 1951, wanting nothing more than to work for Graham directly at his investment partnership, Graham-Newman Corporation, in New York. Graham turned him down at first, reportedly wanting to reserve the limited spots at his small firm for Jewish analysts who faced discrimination at other Wall Street firms and had fewer alternative options. A decision Buffett accepted without bitterness, understanding the practical fairness behind it. He returned to Omaha, worked for a few years at his father's brokerage selling stocks to local clients, and continued studying and investing on his own, including taking a night course in public speaking through the Dale Carnegie program, specifically to overcome a paralyzing fear of speaking in front of people, a fear that seems almost unimaginable in light of the poised, quotable investor he would later become in front of tens of thousands of shareholders every spring. In 1954, Graham finally offered him a position at Graham-Newman, and Buffett moved to New York with his new wife, Susan Thompson, whom he had married in 1952, after a courtship built as much on intellectual companionship as romance. At Graham-Newman, he worked directly alongside Graham, analyzing balance sheets with the same relentless curiosity he had once applied to pinball machine earnings, searching for cigar butts, beaten down, unloved companies trading for less than the value of their net current assets, stocks so cheap that even a company in decline could yield one last profitable puff before being discarded. It was intellectually formative work, but it lasted only about 2 years before Graham decided to retire and wind down the partnership in 1956, sending Buffett, then 25, back to Omaha once again, this time not to work for someone else, but to start something of his own. He returned home with personal savings that by then totaled roughly $174,000, a considerable sum for a man his age at the time, though when he formed his first investment partnership that same year, he structured it with striking modesty. 7 family members and friends pooled together about $105,000 in capital, while Buffett himself contributed only $100 of his own money as the managing partner. A near token stake that nonetheless committed him fully, since his compensation depended entirely on performance rather than on any fee charged regardless of results. Word of the arrangement spread slowly through Omaha's business community, drawing in additional partners over the following years, who trusted him enough to hand over their savings to a 25-year-old with no track record beyond his reputation for being uncannily right about numbers. The fee structure he set up was unusual and revealing of his character. He charged no management fee at all, taking a share of profits only above a set threshold, and absorbing a portion of any losses himself, aligning his own incentives directly with those of his investors rather than collecting a fee regardless of outcome. Over the following 13 years, that partnership eventually consolidated and renamed Buffett Partnership. Limited compounded capital at an annualized rate approaching 30% before fees, a figure so far ahead of the broader stock market's returns over the same stretch that it made the fund, quietly, one of the best performing investment vehicles in the country, all without Buffett ever appearing on television or courting publicity. He operated out of a small office, read voraciously, annual reports, trade publications, Moody's manuals cover to cover, and made investment decisions based on rigorous Graham-inspired analysis of what businesses were actually worth compared to what the market was charging for them. He absorbed failing textile mills, a windmill manufacturer, a department store, and dozens of undervalued small-cap stocks into the portfolio, applying the cigar butt method with such consistent success that word spread among Omaha's business community and, gradually, beyond it, drawing in a widening circle of limited partners. It was during these partnership years, in 1959, that Buffett was introduced through mutual friends to Charlie Munger, a fellow Omaha native who had become a lawyer in Los Angeles. The two men, despite meeting for the first time at a dinner, arranged somewhat matchmaking style by acquaintances who suspected they would get along, discovered an immediate and rare intellectual chemistry, trading ideas about business, psychology, and value for hours. Munger would not formally join Buffett's operations for years, but the friendship that began that night in 1959 would evolve into the most consequential business partnership of Buffett's life, one that would eventually reshape his entire investment philosophy. In 1962, the partnership began buying shares of a struggling New England textile manufacturer called Berkshire Hathaway, a company with declining mills and a shrinking market as the textile industry migrated to cheaper labor in the American South and then overseas. Buffett bought the stock purely as a Graham-style cigar butt. It traded well below its working capital value, making it statistically cheap, even though the underlying business itself was in genuine structural decline. What happened next became one of the most famous cautionary anecdotes he would tell against himself for the rest of his career. In 1964, Berkshire's management, led by Seabury Stanton, offered to buy back Buffett's shares at $11.50 per share, a price Buffett had verbally agreed to. When the written tender offer arrived, showing a price of $11.37, an eighth of a dollar less, Buffett felt cheated by what he saw as a petty, dishonest shave off an agreed price, and rather than simply selling anyway, he reacted emotionally. He began buying more shares of Berkshire Hathaway, eventually acquiring enough to take control of the company and fire Stanton. It was, by Buffett's own later admission, one of the worst business decisions of his life, made out of spite rather than analysis, locking enormous amounts of capital into a dying textile business that would drain value for years. But it also gave him control of the corporate shell that, decades later, he would transform into the vehicle for one of the greatest wealth compounding machines in financial history. Through the 1960s, Munger's influence began to reshape how Buffett thought about investing. Munger pushed him to see the limitations of the pure Graham approach. Cigar butt stocks were cheap because the underlying businesses were often genuinely bad, and buying bad businesses for cheap prices, while occasionally profitable, was not a sustainable path to great long-term wealth, because a mediocre business, given enough time, tends to produce mediocre returns regardless of the price paid for it. Munger's alternate proposition, distilled into one of the most quoted lines to come out of their partnership, was that it was far better to buy a wonderful business at a fair price than a fair business at a wonderful price. A wonderful business, one with a durable competitive advantage, pricing power, and management integrity, could keep compounding value for decades, while a mediocre one, however cheap, would eventually reveal its mediocrity in its returns. The clearest early proof of this shift came in 1972, when Buffett, through Berkshire Hathaway, acquired See's Candies, a California-based candy manufacturer with a loyal customer base and strong brand loyalty, for $25 million, a price that looked expensive by strict Graham standards, well above the company's tangible book value. Munger pushed hard for the deal, despite Buffett's initial hesitation over the price, arguing that See's brand strength gave it pricing power that a cigar butt stock could never offer. Customers would keep buying See's candy year after year, even as prices rose, because the emotional attachment to the brand, especially around gift-giving occasions, made price increases nearly invisible to the buyer. The acquisition proved transformative, not just financially, Seas went on to generate far more in cumulative profits than its purchase price many times over. But philosophically, cementing in Buffett's mind the value of paying up for quality, brand strength, and pricing power, a lesson he would apply again and again for the rest of his career. Around this same period, Buffett wound down Buffett Partnership Limited, which he had begun to feel was operating in an increasingly overvalued and speculative stock market environment in the late 1960s that no longer offered the kind of bargains his method depended on. Rather than chase performance in a market he distrusted, he closed the partnership to new capital and eventually returned money to his limited partners, offering many of them the option to roll their proceeds into shares of Berkshire Hathaway instead. A decision that made some of his early investors, who had trusted an unproven young man from Omaha over a decade earlier, extraordinarily wealthy in the decades that followed. From that point forward, Berkshire Hathaway itself, rather than a separate partnership, became the primary vehicle through which Buffett would build his fortune, converting a dying textile mill into a diversified holding company piece by piece. A crucial piece of that transformation came through insurance. In the late 1960s and early 1970s, Buffett began acquiring insurance companies, starting with National Indemnity, drawn not primarily to the insurance business itself, but to a structural feature of it that most people overlooked. Insurers collect premiums up front and only pay out claims later, sometimes years later, which means they hold large pools of other people's money, called float, that they can invest in the meantime. If an insurer underwrites carefully enough that its premiums roughly cover its eventual claims, the float functions almost like an interest-free loan that can be redeployed into other investments. Buffett recognized float as an extraordinarily powerful tool. It gave him a growing, low-cost source of investment capital that he could deploy into stocks and businesses. And as Berkshire's insurance operations expanded over the following decades, eventually including a controlling stake in the auto insurer Geico, first purchased in the 1970s and later acquired outright in 1996. The float grew into tens of billions of dollars, becoming one of the quiet engines beneath Berkshire's compounding growth. Buffett's reputation deepened during the difficult economic years of the 1970s, a decade marked by inflation, oil shocks, and a bruising bear market that left many investors demoralized. It was precisely the kind of environment in which his patient, value-driven approach thrived. When stock prices fell to levels that others considered too frightening to touch, Buffett, treating market pessimism the way Graham had taught him to, as an opportunity rather than a warning, began buying stakes in companies he believed were being irrationally punished. Among these was the Washington Post Company, in which Berkshire built a significant stake starting in 1973, betting on the durability of its franchise and the integrity of its leadership under Katharine Graham, even as the stock languished amid a broader market downturn. The investment would go on to be enormously profitable and also marked the beginning of a close personal friendship and working relationship between Buffett and Katharine Graham, whom he mentored informally on business and financial matters as she navigated running a major media company during a period of intense political pressure surrounding the Post's Watergate reporting. Buffett's approach throughout these years was built around a small set of durable principles that he would repeat, refine, and apply with remarkable consistency for the rest of his life. Invest only within one's circle of competence, meaning businesses simple enough to genuinely understand rather than ones that merely sounded exciting. Demand a margin of safety between price and calculated value. Prefer businesses with what he began calling an economic moat, a durable structural advantage, whether from brand, cost structure, network effects, or regulation, that protected profits from being competed away. And trust management teams with a demonstrated record of both competence and honesty, since even a wonderful business could be ruined by leaders who lied to shareholders or allocated capital foolishly. He also began, during the 1970s, writing his now famous annual letters to Berkshire Hathaway shareholders, plain-spoken, often self-deprecating essays that explained the company's results and his reasoning in language deliberately stripped of Wall Street jargon, aimed, as he often said, at readers he imagined as his own sisters, intelligent people without specialized financial training who deserved a clear, honest account of how their money was being managed. The 1980s brought Berkshire's stock price into public consciousness in a new way, as its per-share value, still held by Buffett largely as a long-term compounding vehicle, rather than a stock meant for trading, rose from double digits into the thousands of dollars, eventually becoming famous for never having undergone a stock split. A deliberate decision that kept the price high and, in Buffett's view, discouraged short-term speculative trading by attracting a shareholder base more interested in long-term partnership than quick profit. During this decade, Berkshire's portfolio expanded to include stakes in companies such as Capital Cities/ABC, and Buffett continued acquiring wholly owned businesses outright when the price and quality aligned, including Nebraska Furniture Mart in 1983, purchased from its founder, Rose Blumkin, a Russian immigrant known as Mrs. B, whose relentless work ethic and blunt business instincts Buffett deeply admired. He handed her a check for tens of millions of dollars after a negotiation that reportedly took only a matter of minutes, based on a handshake and a single-page agreement, an approach to deal-making built on trust that became something of a Berkshire trademark in acquisitions of family-owned businesses in the decades that followed. A far more turbulent chapter arrived in 1987, when Berkshire had built a substantial stake in Salomon Brothers, a major Wall Street investment bank, through a preferred stock investment made to help fend off a hostile takeover attempt. The relationship with Salomon would remain largely uneventful until 1991, when it emerged that a Salomon trader had submitted false bids in U.S. Treasury bond auctions, violating rules designed to prevent any single firm from cornering the market. And that senior management at the firm had known about the violations for months without disclosing them to regulators. The scandal threatened not just Salomon's reputation, but its very survival, as regulators considered whether to bar the firm from further participation in Treasury auctions, a step that could have triggered its collapse and, given Salomon's size and interconnectedness, sent shockwaves through the broader financial system. With Salomon's existing leadership discredited and its future in serious jeopardy, Buffett, as the firm's largest shareholder, stepped in as interim chairman, an unusual and uncomfortable role for a man who had spent his career as a passive investor rather than an operating executive. He testified before Congress, offering an unusually direct and contrite public accounting that avoided the evasions and lawyerly hedging typical of corporate crisis testimony, telling lawmakers plainly that Salomon had done wrong and pledging that the firm would cooperate fully with investigators and clean house internally. He famously told Salomon's employees that he wanted them to be cautious enough with the firm's reputation that if a decision might make headlines that would embarrass them if their family read about it, they should not do it. A phrasing that stuck as one of his signature statements on business ethics and reputation. His stewardship helped Salomon avoid the harshest regulatory penalty and survive the crisis, though the episode consumed nearly a year of his attention and demonstrated a dimension of his character rarely tested during his mostly hands-off decades running Berkshire. A willingness to step directly into a crisis, take personal responsibility publicly, and prioritize long-term institutional integrity over short-term convenience. The 1990s brought some of Berkshire's most celebrated investments, none more emblematic than its stake in the Coca-Cola Company, which Buffett began building in 1988 and continued increasing into the following years, eventually making Coca-Cola one of Berkshire's largest holdings. The investment thesis was, in Buffett's own retelling, almost embarrassingly simple. Coca-Cola sold a product with unmatched global brand recognition and pricing power, requiring relatively little capital reinvestment to maintain its dominant position, generating enormous and growing free cash flow year after year, precisely the kind of wonderful business Munger had steered him toward 2 decades earlier with See's Candies, only executed on a vastly larger scale. The stake would go on to become one of the most profitable single investments in Berkshire's history, and Buffett's public affection for the product itself, including his well-known habit of drinking multiple cans of Coca-Cola daily, became one of the small, humanizing details that endeared him to a public increasingly fascinated by his outsized success paired with strikingly modest personal habits. Those personal habits became, in fact, part of his public identity as his fame grew throughout the 1990s. Despite a net worth climbing into the billions and eventually tens of billions of dollars, Buffett continued to live in the same modest house in Omaha that he had purchased in 1958 for roughly $31,500. A home unremarkable by the standards of the ultra-wealthy, without gates, without a large staff, situated in an ordinary residential neighborhood. He continued driving relatively unglamorous cars, eating at unpretentious local restaurants, and drawing what was, relative to his wealth, an almost startlingly modest annual salary from Berkshire, a figure he kept fixed at $100,000 a year for decades, arguing that his wealth came from Berkshire's stock appreciation, which he shared proportionally with all other shareholders rather than from executive compensation extracted disproportionately at their expense. This contrast between extraordinary wealth and deliberately ordinary living became, over time, as central to his public persona as his investment record itself, reinforcing an image of a man who found genuine satisfaction in the intellectual work of investing rather than in the trappings that wealth could purchase. His personal life during these years carried its own quiet complexity. His wife, Susan Buffett, moved to San Francisco in 1977 to pursue her own singing career and personal independence, a separation that the couple never formalized through divorce and that did not end their deep mutual affection. Instead, Susan introduced Warren to Astrid Menks, a waitress at an Omaha restaurant the family frequented, and the three maintained an unconventional but genuinely warm relationship for years, with Astrid eventually moving in with Warren in Omaha, while Susan lived independently in San Francisco, an arrangement that close friends described as functioning, in practice, on mutual respect, and Susan's own blessing rather than estrangement. Susan Buffett died in 2004 of complications related to a stroke, and Warren married Astrid Menks in 2006, formalizing a relationship that had already spanned decades. Buffett's relationship with his three children, Susie, Howard, and Peter, reflected the same philosophy he applied to his broader view of wealth. He was famously resistant to the idea of leaving each of them an enormous life-altering inheritance simply because he happened to be their father, articulating a view he summarized as wanting to give his children enough money so that they would feel they could do anything, but not so much that they could do nothing. A phrase that circulated widely as encapsulating his broader philosophy about inherited wealth, potentially sapping ambition and purpose from those who receive it without having built it themselves. Peter Buffett, his youngest son, pursued a career in music rather than finance, later writing candidly about growing up with a famous wealthy father while being expected to build an independent life and career, rather than simply inherit position or comfort. As Berkshire Hathaway grew into the late 1990s and beyond, it evolved into an increasingly diversified conglomerate stretching well past its origins in textiles and cigar butt stock picks, wholly owning an expanding collection of operating businesses that Buffett often described using a metaphor of a sprawling, decentralized holding structure. He provided capital and, occasionally, broad guidance, but left day-to-day management almost entirely in the hands of the operating executives running each business, a structural philosophy rooted in his consistent preference for trusting proven managers rather than layering corporate bureaucracy on top of them. Acquisitions during this expanding era included Dairy Queen, the furniture and jewelry retailers that followed the Nebraska Furniture Mart model, and later, in the 2000s, much larger deals, including the Burlington Northern Santa Fe Railroad, acquired in a deal completed in 2010 for approximately $26 billion, at the time the largest acquisition in Berkshire's history, and a striking bet on the long-term durability of American rail freight infrastructure. At a moment when many investors considered railroads an unglamorous, low-growth relic of an earlier industrial era, the financial crisis of 2008 tested, in real time, nearly every principle Buffett had spent his career articulating. As credit markets froze and once mighty financial institutions collapsed or teetered near collapse, Buffett, sitting on enormous reserves of cash that critics had periodically questioned him for holding on to during the preceding bull market, moved decisively to deploy capital while panic gripped nearly everyone else, embodying a principle he had distilled years earlier into one of his most quoted lines: "To be fearful when others are greedy." and greedy when others are fearful. He negotiated preferred stock investments carrying highly favorable terms into Goldman Sachs and General Electric during the darkest weeks of the crisis, providing capital those institutions urgently needed while extracting attractive dividend yields and warrants that would prove enormously profitable for Berkshire as markets eventually recovered. He also published an opinion piece in the New York Times in October 2008, urging ordinary investors not to panic and to consider buying American stocks even amid the chaos, an act of public reassurance from one of the most credible voices in American finance at a moment when confidence in financial institutions and their leaders had collapsed almost entirely. Buffett's public philanthropy took on a defining new shape in 2006 when he announced that he would gradually give away the vast majority of his fortune, directing the bulk of it not to a foundation bearing his own name, but to the Bill and Melinda Gates Foundation, run by his close friend Bill Gates, whom Buffett had met in 1991, and with whom he had developed both a deep personal friendship and a shared conviction about the effective, evidence-based application of philanthropic capital toward global health and poverty reduction. The decision to funnel his giving through an already highly capable, operationally sophisticated foundation, rather than build a large namesake institution of his own, reflected the same efficiency-minded logic he applied to business. Rather than duplicate infrastructure and expertise that already existed and worked well, direct resources toward the platform most likely to use them effectively. In 2010, Buffett and the Gateses formally launched the Giving Pledge, inviting the world's wealthiest individuals and families to publicly commit to giving away the majority of their fortunes, either during their lifetimes or upon their deaths, an initiative that would eventually be signed by well over 200 of the world's richest people across dozens of countries, reshaping, in some measurable way, the culture of expectation around how extreme wealth ought to be handled by those who hold it. Charlie Munger, who had formerly become vice chairman of Berkshire Hathaway and Buffett's most consistent public sparring partner and intellectual foil, remained by Buffett's side for over 6 decades, the two men appearing together for years at Berkshire's annual shareholder meetings in Omaha. Gatherings that grew from small, informal affairs held in cafeterias in the company's early decades into massive weekend events drawing tens of thousands of shareholders from around the world, an event nicknamed Woodstock for Capitalists, where Buffett and Munger would field hours of unscripted questions on subjects ranging from specific investment decisions to broader reflections on ethics, aging, and how to live a satisfying life. Munger's famously blunt, often acerbic wit balanced Buffett's warmer, folksier public style, and the two developed a shorthand built on decades of trust, often finishing each other's points or offering wry, one-line corrections to each other's answers that shareholders came to anticipate and treasure as part of the event's appeal. Munger died in November 2023 at the age of 99, just weeks before what would have been his 100th birthday, and loss Buffett described publicly with visible emotion, crediting Munger repeatedly across decades of interviews and letters as the person most responsible for pushing him beyond the limitations of pure Graham-style investing and toward the philosophy of paying fairly for quality that had defined Berkshire's greatest successes. Buffett had, for years before Munger's death, been methodically preparing Berkshire for a future without him at its center, a subject he addressed with the same clear-eyed pragmatism he applied to every other business question. In 2021, he publicly identified Greg Abel, who had been serving as vice chairman overseeing Berkshire's non-insurance operations, as the board's chosen successor to eventually become chief executive, a designation intended to give shareholders, employees, and markets clarity and confidence about the company's leadership continuity long before any actual transition needed to occur. For years, most observers assumed that transition would only take place after Buffett's death, given his evident vigor and his repeated public statements that he had no plans to retire. That assumption was overturned in May 2025 at Berkshire's annual shareholder meeting in Omaha, when Buffett, at the close of his customary marathon question and answer session with shareholders, announced that he would recommend to Berkshire's board that Greg Abel be appointed chief executive effective at the start of the following year. The announcement caught even the audience of seasoned Berkshire watchers off guard. Buffett later revealed that he had kept the timing secret from almost everyone, including Abel himself, who was reportedly seated nearby without any advance warning of what was about to be said. In the months between that announcement and the actual transition, Buffett continued corresponding with shareholders, including a widely read letter distributed around Thanksgiving of 2025, in which he confirmed his intention to retain a significant portion of his Berkshire shares for the time being rather than immediately liquidating his position, explaining that he wanted shareholders to develop full confidence in Abel's leadership first, a confidence he expressed no doubt would arrive quickly, noting that his own children were already fully supportive of the succession and that Berkshire's directors stood behind it unanimously. He also indicated in that same period that he intended to keep writing to shareholders even after formally stepping down, a signal that while operational control was passing to Abel, the plain-spoken teaching voice that had defined Berkshire's public communication for half a century was not disappearing entirely. On December 31st, 2025, Warren Buffett officially stepped down as chief executive of Berkshire Hathaway, and Greg Abel assumed the role at the start of the new year, becoming only the second person in 6 decades to hold that title at the company. Buffett, 95 years old at the time of the handover, remained chairman of the board, a position from which he continued to offer guidance while allowing Abel full authority over operations and capital allocation. In television appearances that aired around the transition, Buffett spoke with evident confidence about his successor, describing Abel as the decider going forward, and remarking that he would rather trust Berkshire's money to Abel than to any other executive or investment advisor in the country. A public vote of confidence intended to reassure shareholders who had, for decades, associated Berkshire's success almost inseparably with Buffett's personal judgment. The scale of what had been built by the time of that transition was almost difficult to fully absorb. A company that had begun as a failing New England textile mill, purchased partly out of spite in 1965, had grown under Buffett's 6 decades of stewardship into one of the largest and most valuable corporations in the world, encompassing insurance, railroads, energy utilities, manufacturing, retail, and a public equities portfolio worth hundreds of billions of dollars built almost entirely through the patient, repeated application of a small number of simple, consistently articulated principles rather than through financial engineering, aggressive leverage, or speculative bets. Along the way, Buffett had become not merely one of the wealthiest individuals on earth, but arguably the most trusted single voice in American finance, a reputation built cumulatively across decades of annual letters, congressional testimony, shareholder meetings, and public commentary that consistently prioritized plain language, intellectual honesty about his own mistakes, and a genuine demonstrated concern for the interests of ordinary shareholders rather than merely the interests of executives and financial insiders. The late 1990s tested Buffett's discipline in a different, more public way than any market crash could have. As internet-related stocks soared to valuations that bore little relationship to their earnings, or in many cases to any earnings at all, Buffett refused to participate, repeating a principle he had held since his earliest days studying under Graham: never invest outside what he called a circle of competence, the boundary of businesses simple and knowable enough to be judged with real confidence. He could not explain, with the same precision he applied to insurance float or candy margins, how a given .com company would generate durable profits a decade later. And rather than guess, he simply declined to play. For a stretch of the late 1990s, this restraint made him look to a new generation of investors and financial commentators like a relic who had lost his touch, and Berkshire's stock underperformed the broader market noticeably during the frothiest years of the boom, prompting public second-guessing of his relevance. When the dot-com bubble collapsed in 2000 and 2001, wiping out enormous amounts of paper wealth built on companies with no sustainable path to profitability, Buffett's refusal to chase the boom was vindicated so thoroughly that it became one of the defining episodes cited in support of his broader philosophy, that avoiding what you do not understand, even at the cost of looking outdated for a while, protects capital far more reliably than chasing whatever happens to be exciting at the moment. That episode also crystallized something Buffett had long argued about investing that had little to do with raw intelligence. He periodically pointed out that success in markets was not primarily a function of a high IQ, noting that plenty of brilliant people had lost fortunes through impatience, overconfidence, or an inability to control their emotions during periods of market stress, while investors of only ordinary analytical ability could do extremely well simply by remaining rational when others panicked or grew euphoric. The 2000s brought a genuine surprise to longtime Berkshire watchers, who had grown accustomed over decades to Buffett's avoidance of technology stocks, a category he had long argued fell outside his circle of competence because the pace of technological change made it too difficult to forecast which companies would still hold durable advantages a decade or two into the future. Starting in 2016, Berkshire began quietly building a position in Apple. His reasoning for Apple broke from the usual narrative of buying a tech stock at all. He described it instead as an investment in an extraordinarily powerful consumer products company with fierce customer loyalty and significant pricing power, characteristics indistinguishable from the consumer franchise logic that had driven the See's Candies and Coca-Cola investments decades earlier, just expressed through iPhones rather than chocolate or soft drinks. The position grew to become, for a period, Berkshire's single largest public equity holding, and by the company's own later account, one of the most profitable investments in its history, generating tens of billions of dollars in unrealized gains and dividends over the following years, even as Berkshire trimmed portions of the stake in later years to manage concentration risk and tax considerations. The onset of the COVID-19 pandemic in early 2020 delivered another sharp test of Berkshire's resilience and Buffett's temperament under crisis conditions, echoing in some ways the 2008 financial crisis, though the underlying cause was a global public health emergency rather than a banking collapse. Markets fell with extraordinary speed in March 2020 as economies around the world shut down, and Berkshire, despite sitting on a massive cash reserve that many observers assume would again be deployed aggressively, as it had been in 2008, moved with unusual caution during the sharpest part of the downturn, a restraint that drew public criticism from some shareholders and commentators who expected Buffett to be buying assertively while others panicked. Buffett later explained that the extreme uncertainty introduced by a novel virus with unknown economic and health consequences made the situation fundamentally different from a purely financial crisis. As markets recovered through 2020 and into the following years, Berkshire redeployed capital more assertively, building a substantial stake in Occidental Petroleum, starting in 2022 amid a resurgence in energy prices following geopolitical disruptions to global oil markets, and continuing to expand major positions in a group of large Japanese trading companies, Mitsubishi, Mitsui, Itochu, Marubeni, and Sumitomo, an investment thesis Buffett explained in characteristically simple terms as a bet on diversified, well-managed conglomerates trading at prices that undervalued their steady cash flows, financed partly through low-cost, yen-denominated debt that hedged much of the currency risk involved in owning foreign assets, a rare instance of Buffett applying meaningful financial engineering to an otherwise straightforward value investment. These Japanese holdings, built patiently and quietly over several years, without the fanfare that accompanied Berkshire's American investments, came to represent one of the largest and most successful international bets of Buffett's later career, praised by Japanese business leaders themselves as a rare example of a foreign investor engaging with their conglomerates thoughtfully rather than opportunistically. He spoke candidly, in interviews conducted in his 90s, about having outlived most of his early contemporaries and closest collaborators, including Munger, and about approaching the final chapters of his own life with the same unsentimental clarity he applied to a balance sheet, describing himself as fortunate to have spent his working life doing something he loved among people he trusted, a sentiment he repeated often enough that it came to function almost as a personal creed distinct from, but inseparable from, his investment philosophy. By the time Greg Abel took over day-to-day leadership of Berkshire Hathaway in early 2026, Warren Buffett's life had traced an arc that began with a 6-year-old boy reselling bottles of Coca-Cola for a nickel of profit on the streets of Omaha, and ended, 9 decades later, As the retired chairman of a company holding a controlling stake in that same beverage giant among hundreds of billions of dollars in other holdings, what had carried him from one end of that arc to the other was never, by his own repeated account, a matter of unusual genius or secret formulas. It was an unusually deep and lifelong patience, a willingness to say no to opportunities outside his understanding no matter how fashionable they became, an insistence on honesty in both his public communication and his private dealings, and a simple, stubbornly maintained belief that time, applied consistently to a sound and honestly run business, would eventually reward those willing to wait for it.